Well, hello everyone. Clint Lee here, along with Ted Bauman for the next edition of Your Money Matters. I know some of you are going to be disappointed today. Angela is taking the day off, but don't worry, she will be back next week. Before we get into our topic today, there's one thing I want to mention real quick. A couple weeks ago, Ted and I, we were both discussing some of the implications of a vaccine coming to market a little bit quicker than what everyone was anticipating. And pretty much the implications that has for the stock market is if we see that return to normal sooner than expected, that is a risk that could derail the rally we've seen in the stay-at-home stocks, in the high-growth tech area of the market, and at the same time boost the cyclical areas. We discussed this topic a couple weeks ago, and just the reason I'm bringing this up is because that topic is making the rounds this week. Goldman Sachs out with their own report highlighting pretty much the same thing, that a vaccine coming to market sooner than expected poses a risk to these mega cap tech stocks that have seen a nice tailwind, quite frankly, from the pandemic. And so that's something to keep an eye on. I mentioned that boosting cyclical areas of the market as well. So if you want more details, you can go back and view those videos on our YouTube page here for a recap of what we were saying at that time. Now, we've been highlighting these cyclical areas of the market, the value areas of the market for quite some time now. And quite frankly, we've been positioning within many of those segments within our own trading services. So actually our weekly trading service, our Alpha Stock Alert portfolio, I'll flash a graph here real quick of what that performance has looked like just over the last month or so as we've been discussing this topic. And you can see the blue line is our ASA, our Alpha Stock Alert positions relative to what the S&P 500 and the NASDAQ have done, up about 14% over that time. That's double what the market has done per those two indexes. But Ted, you and I have been talking recently. We've been starting to go down a different path, thinking along a different train of thought, what policy here in the U.S. means longer term, and what kinds of what kind of threats that might mean here domestically, or what kind of opportunities that might open up in other areas. Mm-hmm. Would you take us through that train of thought and what you've been thinking about here lately?
Yes, I will. I think, first of all, there's an important distinction between the short term of the stock market and the big picture, the long term. I mean, a lot of the traders who are out there today who are trading, particularly retail traders, are people who have never really seen a down market. Anybody who was in their teens at the time of the great financial crisis has only seen up markets with a few corrections. But over the longer term, there's been a lot of ups and downs in the stock market. And what I spoke about on Friday, I just want to recap because I think it's a critically important idea because it eventually, there is going to be a shift based on changes in those circumstances. In a nutshell, U.S. tax policy rewards capital. It penalizes hiring labor. High healthcare costs borne by employers do the exact same thing. The strong dollar also encourages capital-heavy, labor-light companies, particularly in the service sector, technology, financial services, etc. The problem is that has created a very unequal economy. We've seen that a lot of people are really struggling. It's precisely the kinds of jobs that get created in this kind of economy that are falling away under COVID, restaurant, short-term, part-time, etc. And that has made the economy extremely vulnerable. So in a sense, we've been concentrating on efficiency rather than resilience in our economy. And we're suffering as a result of that, under COVID. We're seeing the consequences, not just socially, but in terms of not having the ability to manufacture things we need to fight COVID. So the key thing is this is all based on political choices that can be changed. And my thesis on Friday is that we could be heading into a situation, especially thanks to COVID, where politicians are beginning to think about making those changes. If they do, for example, they could end up shifting some of the tax burden away from employment, reducing our reliance on payroll taxes, and start using general taxation as a way to fund the social safety net. That would lower the returns on capital. That would make U.S. equities relative less attractive. The second thing that could happen is that you could see regulatory action taken against some of the big companies that effectively have oligopoly positions and earn excess profits because of that, not just in technology, but in communications, for example, in media, in the telephone and cell service, internet service. And then, of course, we could see a weaker dollar also because of the impact of very, very low interest rates and increasing US government debt. Now, all of that would push policymakers in the direction of trying to reverse some of this. And some of the things that I think we could look at would be, incentives to onshore, to bring production back to the United States. Now, if you do that with our relatively higher cost structures, you threaten the profit levels, the profit rates, the margins of a lot of companies. And that in turn puts pressure on US equities because ultimately they're based on earnings and not just revenue. So fundamentally, my point on Friday is that this could be coming. A couple of people asked me to say when. I'm not going to get drawn into that. It's a fool's errand to try to predict when. But the chances are that this is all coming together if we see a change in politics, particularly if we see a Democratic sweep of the Congress, the Senate, and White House. We could see this a lot sooner than we expect. That would have some implications in terms of where money is to be made. And you've, I know, done some thinking on that. Tell us what you think that could mean.
Yeah, well, you're talking about some of these issues potentially weighing on profit margins, on earnings. And this all comes at a time when valuations are running at their highest levels since the dot-com bubble. And that has some serious implications. But before we get there, what we're starting to look at is the opportunities in the international space. Now, we've talked a lot. There's been, for good reason, we've been fixated on what's going on domestically, the domestic economy, areas to invest in the US stock market, and the international markets have kind of fallen by the wayside. But because of that thought process, we're starting to take a look there once again. And now we've been conditioned for really over a decade now to just expect and anticipate international underperformance in their stock markets relative to what we've seen in the US. But that's not always the case. I'll show a chart right here. This shows the S&P 500 is the blue line against an emerging markets index, that's the red line, and a broader international market index, which is the green line. And if you look at the left-hand side of this chart, you go back kind of to the mid and early 2000s, you see this surge in emerging market performance relative to the S&P. We had a commodity boom at that time, helping out countries like Brazil and Russia. We had the ascension in fast-growing economies in China and India, and that was reflected during that time. But since then, those markets have just really traded sideways, as you can see here, even though the S&P 500 was going on to make new highs. Now, I want to come back to that valuation argument for just a moment, because that has important implications. I mean, if you're buying and selling stocks based on a holding period of a few days, a few weeks, or a few months, valuations aren't a big catalyst that you need to worry about. But when you start looking out, becoming a long-term investor, looking out 5 years, 10 years, that's where valuations can have a significant impact on the return that you earn. And I'll show another chart right here. This was put together by GMO. They release their projections for asset class returns, and valuations factor heavily into these projections. And so if you look at the left-hand side of this chart, you'll see that US large cap equities on an average annual basis for the next 7 years are expected to post a negative return of about 1.5%. But you contrast that to where, say, emerging markets are. You start to go to the right-hand side of this chart. You see emerging markets expected to put up a return of closer to 5%, a more specialized asset class like emerging value in double digits annually for the next 7 years.
Yeah. So let me stop you there and just point out some of the dynamics behind this. This is not necessarily about the performance of the economies in question. As I've mentioned in a couple of recent videos, you get to the point where the rate of expected future change of a particular asset class will slow simply because it has reached a peak valuation. When that happens, investors go looking for yield elsewhere. And it doesn't necessarily mean that emerging markets have to be better performing. It just means that a lot of people want to buy their shares, and that pushes up those share prices. But in terms of the thesis that I mentioned earlier, that I think there are some political structural changes coming in the United States economy going forward that would tend to favor them, because they are countries that operate on a very different type of scenario. You have companies there that can make very high profits because they're able to make things at very low cost. They have still low labor costs. I'm thinking of countries in Southeast Asia, companies in East Africa that are starting to develop manufacturing capacity that we see up and coming. I've mentioned this in a couple of Bauman dailies going back a ways. So remember, there's two factors here. One is that these economies will start to do better relatively as people look for new places to make things other than China. But the second thing is that investors will simply go there looking for profits, and that will tend to push up prices. In a sense, that's exactly what's happened to the US stock market. We've all heard of TINA, right? There's no alternative. So one of the things that we're all used to is the idea that stocks go up because people are buying them, not because they're worth more. So my point is that that could happen in this scenario as well. But the backdrop is that I do think that eventually, don't know when, we're going to see this big movement towards a structural change, lower our healthcare costs, rein in the freedom that capital currently has, try to transfer more wealth to working people in the United States, and that'll have a big impact. Clint, I know you've looked at a couple of specific ETFs we can use to play this. Remember, folks, these ETFs are based on, are thinking about where things are going, not exactly when. So the question is, if you start seeing signals in this direction, that's when you buy. We're not saying you need to buy them today. Put them on your watch list.
Yeah, so for a broader emerging market exposure, the one ETF I would take a look at is IEMG. I know a lot of people are familiar with EEM, but with IEMG, you can get it for cheaper, meaning a lower expense ratio the last time I checked. And it also gives you a broader emerging markets universe within that ETF as well. If you want a more select, unique idea, Ted, you mentioned companies looking to shift their manufacturing bases away from China, whether it's the cost standpoint or the US-China trade relations. In Southeast Asia, Vietnam is one to consider. Ticker VNM is an ETF that tracks that country's investable universe. But then also, just want to circle back to what we were talking about to start off this Your Money Matters video, and that is that cyclical call. And I just want to reiterate what we've talked about there, the opportunities we discussed there. Areas of the market that could stand to benefit include domestic mid caps and small caps. You can get exposure there with tickers IWR for mid caps and IWM for small caps. And then from a sector standpoint, we've talked about industrials with the ticker XLI, as well as the recovery that we've seen in the housing market as well. Even with everything going on, there's a lot of strength there. But if we start to see the economy get back to normal, that could be more tailwinds for housing as well. And we've recommended ITV there in the past.
Right. So there you have it, folks. Really what we're talking about is a two-stage potential rotation. We could see, as Goldman Sachs has agreed with us, we could see a shift into domestic mid and smaller caps, as well as industrials and cyclicals, if a vaccine looks like one is going to succeed. So be ready for that. Have those ETFs on your watch list. The second one is longer term. We could see a shift back to emerging markets and also just international stocks in general. I think Europe has already factored in a lot of the cost structures that the US will start moving towards, which will give them a temporary leg up as we do that. So remember, the US is not the only game in town. We know that you're making money right now by buying high and selling higher, but that won't always be the case. And we're trying to think ahead. Anyway, that's enough for us this week. We'll see you next week. Clint, thank you very much. And folks, boys, Angela will be back next week, we promise. Take care.